Time for the latest earnings outlook now with Research Director Shiraz Mian. So far, Shiraz, it seems that results for Q3 earnings coming in on the mixed side with a few high-profile disappointments. Does that kind of accurately describe it?
I think so, yeah. I think that's a fair assessment. The expectations getting into the earnings season were on the weak side, but we are seeing, as you rightly put, quite a few high-profile misses. The IBM miss last evening and the Goldman Sachs miss on the top lines this morning would definitely fit into that. I have the scorecard for the season as of this morning.
And I just want everybody to know that you and I are sitting here talking about this on October the 17th.
That's right.
Morning of October the 17th.
So we have today Google reporting after the close, but all the other reports that were supposed to come today, they are incorporated in the scorecard.
Okay.
We have 80 companies in the S&P 500 as of this morning reported Q3 results. 420 are still expected to come. As you look at the scorecard table, we have about 23.5% of the entire market cap results already announced. So it's early, but we still have a sizable enough and representative enough sample to get a sense of how it's moving. 2.2% total earnings growth for these 80 companies, 65% of the companies beating expectations, 1.7% top line growth, and 40% beating top line expectations. A couple of sectors have quite a few reports in. So in this table, I show that finance has 46% of its market cap already reported results. Transportation and technology are the two sectors where the sample size is good enough that we could start drawing conclusions from that for the rest of the earnings season.
Have you noticed any evidence that the bar for expectations has been lowered?
That was the operating assumption. I think it's fair to continue believing in that assumption. I have been talking about this persistent trend of estimates coming down ahead of the start of the earnings season.
Right.
In response to company guidance. This has been going on for a good 5-6 quarters now. The expectation for the Q3 season was for earnings growth north of 5% in early July when the quarter started, and by the time Alcoa got around to releasing results, it was below 1%, in fact, essentially flat. So the expectation had come down enough that it appeared that we will see a repeat of that under-promise, over-deliver kind of game that we have become accustomed to seeing in earnings season. But we are seeing enough negative surprises that you could question that expectations may have been just fair. They may not have been low enough for companies to easily jump through them, and that seems to be what we are seeing from some of these high-profile misses and the overall negative trend.
What about the pace of companies announcing better than expected earnings this quarter? Slower than average?
Yes, it is, and that ties into what you were talking. I have a chart here that compares what we have seen thus far with what the same 80 S&P 500 companies had reported in Q2, and also the average for the last 4 quarters. And as you can see, this chart shows the earnings and revenue growth rate. So you could see the 2.2% earnings growth rate for these 80 companies compares to 12.3% growth for these same companies in Q2, and 6% earnings growth for the same companies in the 4-quarter average. Mm-hmm. The revenue growth rate is weak as well, relative to these previous quarters, and to the point that you raised, the beat ratio and the level of surprises, those are decidedly on the weak side too, particularly relative to Q2. And you will recall that Q2 was in no way a standout quarter in terms of growth or beat ratios. So definitely, what we are seeing is that the growth rate for these 80 companies and the beat ratios for these 80 companies are tracking lower than what we saw from these companies in Q2. and an average over the last 4 quarters as well.
Still too early in the game here to pick out any meaningful standout sectors?
Yes and no. And the reason I'm saying that is that in the early going, finance typically is a big player and has an outsized weightage. As I showed at the top in the scorecard chart, finance has about 45% of the market cap for the sector released results already, about a quarter of the market cap for technology and transportation. So we haven't really seen much from outside of these 3 sectors to be able to draw conclusions from, but we could draw conclusions about these 3 sectors at least.
Okay.
Finance is the strongest sector, continues to be, as we have been seeing over the last many quarters, but the growth rate and the beat ratios for finance are just like for the broader S&P, weaker than Q2 and also the 4-quarter average. And the issues in the finance sector, as this morning's Goldman Sachs report confirms, the capital markets activity on the fixed income side particularly was weak. Mortgage activity for the broader financial services firms like JP Morgan, Bank of America, Wells Fargo, Citigroup, those were weak for all of those firms as well. The equity market activity was relatively better. Loan demand has been on the weak side, though some firms have better results than others. We saw better results from Bank of America and American Express than we saw from Wells Fargo and JP Morgan. So a mixed picture, still stronger than the rest of the S&P 500 for finance, but weaker than what we have become accustomed to seeing from finance in recent quarters. And if we strip finance out of the S&P 500, we are in the negative. So total earnings outside of finance are quite weak.
Okay. Finally, you've been saying right along here that Q4 guidance is going to be real important here. With all of the recent events in Washington that have taken place, do you expect any impact on earnings from those events? We haven't really heard yet much from companies on how the shutdown and the debt ceiling issue has been at play. But like, as I mentioned, the fixed income markets were weak in Q3, and we saw that across the board for all of the firms. Typically, companies guiding lower will use a kitchen sink approach to throw everything at finding an excuse, and I wouldn't be surprised if companies cite the shutdown and related uncertainty as one of the reasons for guiding lower. But the guidance for Q4, as you rightly point out, is important, and I'll tell you, I'll show you a chart why it is important, and that's the extremely high expectations for total earnings growth in Q4. As this chart shows, we have barely any growth expected in Q3. This is the composite growth, the 0.4%, when we combine the 80 companies with the 420 still to come. So the total earnings growth for these companies is 0.4%. It'll most likely be better than this when all is said and done. But I wouldn't be surprised if it's lower than what we have seen in Q2 and Q1. But 9.6% in Q4 is a stretch. My expectation is that companies will be guiding lower, and as that guidance comes through, these estimates for Q4 will start coming down. The question then is how the market reacts to these lowered expectations. It hasn't really cared much over the last 4 to 6 quarters, but there was the time when the Fed was firmly standing behind everybody. The Fed seems to be standing still firmly behind the market, but there's questions about when the taper will start, whether it's later this year or maybe in the spring, but it will start at some stage. And when it starts, these lowered expectations have to be taken eventually into account. Okay, thanks for that. We have to leave it there for time, but you can always take a look at Shiraz Earnings Trends written report on our website, Zacks.com. Link to it right off the home page. And all through earnings season, especially through the peak periods, you can get the up-to-date comments and trends that Shiraz sees and outlines in our Ahead of Wall Street section. of Zacks.com. With Shiraz Mian, I'm Terry Ruffalo.